So hi, my name is Matt Pointer, and I decided I would record at home this presentation that I've made and given at a few conferences about personal finance. So the title that I've given this presentation is called Money, Medicine, and the Meaning of Life. And I realize that's a little bit of a lofty title, but I think it accurately describes kind of what I have to say about these things. Because I think that what's really important about personal finance is not really the technical details of RRSPs versus TFSAs and things like that. It's about having the knowledge and the skills that we all need to start using our money as a tool to kind of design and build the kind of lives that are meaningful and fun for us. And that's something that at least I see seems to be missing in a lot of people's lives. So I'm actually going to take it one step further from my title and say that I actually believe that if all of us were to follow these things that I have to say in my presentation here, we could actually all have lives that are more fun and more meaningful. So let's get right into it. What's the big secret? It's not Bitcoin. It's going to be a handful of lessons that I've learned over my almost 20 years of experience as a DIY investor and money geek. So before we get into it, though, just a little bit about myself. I'm a family guy. This is my family, and even though my wife has never worked outside the home, and we have 4 kids, at 41 years old now, for me, we've now achieved a level of financial independence. So I can work if I want to, and I can work at the things that are meaningful to me. But it's now a choice. Also, I think it's important to say that I don't work in the financial services industry at all. So I don't have any conflicts of interest. I don't have anything to sell. All I really care about is really my core belief that being good with money is not about having millions of dollars or living in a mansion or driving a Tesla, because you can have all of those things and still be completely miserable. It's really about having the sense to use your money properly and in line with your own values. So before we get into that, I just wanted to get into a more of a psychological phenomenon that is actually very relevant to this conversation, and it's called the Dunning-Kruger effect. I mean, you'd think that as human beings, the more we know, the more confident we would get about that subject matter. But actually, the relationship between knowledge and experience and confidence is not linear at all. With a little bit of knowledge, we actually get very overconfident. And the reason for that is because with a little bit of knowledge, we don't know what we don't know. So when we're faced with a situation, we have a hard time saying, I don't know. And then as you gain more knowledge, then you realize, oh, there's maybe more to this than I thought. And then you kind of reach the low point of your confidence when you have a little bit more knowledge in the field and you say, oh man, I'm never going to get this. This is just too complicated. And I think that's where a lot of people are when it comes to personal finance. And I think that some of that is probably intentional by the finance industry. They want us there because that justifies their existence. And it justifies their high fees. But hopefully by the end of this little talk, we'll all move a little bit further along that curve where it's starting to make sense. Because there's a lot of craziness going out there. Take some Canadian statistics, for example. They're pretty scary. You know, the average savings rate for Canadians is the lowest of all the OECD countries at 2.5%. At that rate, it's actually mathematically impossible to ever become financially independent. 1/3 of people who hold a mortgage in Canada say they couldn't afford a 1% rise in interest rates. 60% are not saving for retirement. The average Canadian owes almost $2 for every dollar of disposable income that they have. And it's also interesting to note that low financial health is actually correlated quite strongly with poor physical health as well. But the sad paradox to me is that this is all happening at a time when we actually have more than we've ever had. You know, we actually live in the golden age now. We live in these big, beautiful houses. which are climate controlled and safe. We drive around in oftentimes luxury vehicles. We can get wherever we want in no time at all. We all basically carry a supercomputer in our pocket. And yet, so many of us are not living the kind of lives that we want to be living. We're stressed out. We're neglecting our relationships, neglecting our passions, and even neglecting our health. We feel trapped at our jobs, suffocated by our to-do lists even when we're not working. Why? Now, I work in the medical field, and certainly doctors can't complain that they don't make enough money. But we all know colleagues who are, whether it's in medicine or not, who are clearly working because they feel like they have to and not because they want to. In the field of medicine, if I were a patient, what kind of doctor would I want to see? I'd want to see the guy who looks like he wants to be there. So we all know that money is a currency to buy things, but it's also the currency to buy a happier life. So I think that doctors are actually uniquely equipped to manage money well. We need to start practicing evidence-based money. If you were presented in the emergency room with a type 1 diabetic who looked terrible and had high sugars for the last couple of days, you wouldn't just jump in there and manage that patient flying by the seat of your pants. You would follow an evidence-based, systematic approach to that patient. Now, given that there actually is evidence to guide our financial decisions, why wouldn't we treat our financial life in the same way? And I think the biggest reason for that is that the world of finance and investing can be pretty intimidating and confusing. There's a lot of misinformation out there. And again, I think that a lot of this is intentional. And we're told things like buy low and sell high, which sounds great on the surface, but it's probably the worst advice ever because it's all predicated on knowing what happens next. And of course, none of us can tell the future. We're told that we need professional help because this stuff is too complicated. And we're told that professional help is worth the high fees that we have to pay for it because these are experts. Then we're also told that the key to wealth is maximizing investment returns, and that's not true at all, as you'll see in a few minutes. And then lastly, we're told that the most important thing when we're managing our finances is choosing the right investment. And again, I will show you in a few minutes how untrue that is. And so to illustrate these points, I thought maybe the best way to do this would be to take you through my evolution as a money geek. So I'm going to start this way back in the year 2000. This is actually before I had any money myself, but I was able to learn by things I was observing around me. And the biggest lesson I learned then was to have a plan that you can stick to. It does not need to be the best plan. Even a bad plan that you can stick to is better than having no plan at all. And the way that I learned this is by an experience that my father had. He worked at Nortel for a lot of years, and part of working there, he got stock options. So he accumulated in his portfolio a fairly large number of Nortel stocks. And some of you may remember this, but in the late 90s, the Nortel stock price just started skyrocketing. So my dad is pretty good with money overall. He had other investments as well, but he was just seeing his Nortel stocks rise in value like crazy. And he was actually in the situation where if he sold his stocks, he could retire early very, very comfortably. But he didn't stick with his plan. And he rode those stocks all the way up to the top. And then when they started dropping, he still didn't sell. And for the most part, he rode the Nortel stocks all the way to the bottom, and they became completely worthless. Now, he was still perfectly fine because, like I said, he had other investments and he was diversified in other ways. But he suffered because he didn't have a plan that he could stick to. And this isn't to pick on my dad at all, because even one of the greatest minds in history, Sir Isaac Newton, did the same thing a couple of years ago with the South Sea bubble. The moral of the year 2000 for me was to have a plan, even if it's not the best plan. Have a plan that you can stick to no matter what the stock market does. Jump forward a couple of years, and I was a resident, and I started earning a paycheck. So even though I had a lot of student debts, I figured I had a couple of $100 a month that I could invest. And so I walked into my bank. And I told them that I wanted to start an investment account. And I was really floored by the warm reception I got. I was ushered into these beautiful offices. I was offered coffee. I was introduced to this really, really nice sales guy. And I was sat down in his office. He had all the time in the world for me. And all of it was for free. I was getting free advice. I couldn't believe my luck. Of course, it's not luck at all, because I walked out of there with a whole bunch of CIBC mutual funds. I was shown a lot of charts of past performance, making their products look good. And if it wasn't their product, then it was another mutual fund with high fees. And what I learned after the fact is, and this is not unique to CIBC, this is rampant in the financial world, there's conflicts of interest everywhere. You really can't trust anyone to have your interests, put your interests first, except you. Because the way that these financial advisors are compensated is through the products that they promote, for the most part. Most of these people are not held to what's called a fiduciary standard. Now, that's a big word. All fiduciary standard means is that they must put the client's best interest first. But most financial advisors and planners are not held to that standard. They're held to a standard of suitability, which means that they can only promote products to you that are quote unquote suitable. Now, of course, the interpretation of that is quite broad. So the moral of that story in 2003 was you got to be a skeptic. And this is just a quick illustration to show the money that is lost by retirement savers like you and I to the financial advisors with conflicts of interest every year. I only have stats for the States, but it's in the billions of dollars. So the next year, I'm still learning lessons the hard way. And I look back at those mutual funds that I was sold and looking at the fees. And my average fees for these mutual funds were about 2%, which I didn't really think much of at the time, because 2% doesn't seem like very much. But I'll just get you guys to think in your heads about this fairly common scenario. If you invest $100,000, earning 6% a year for 25 years with fees of 2% per year, how much less will you have in the end due to fees? 2%, 20%, 40%? The problem with the way our minds work is that we think of 2% as being 2 out of 100, but it's really not. It's 2 out of that 6% return, because these funds are collecting their fees whether the value goes up or goes down. And so the answer to this question is actually 40%. And this is just an illustration to show that. This comes off the Vanguard website. We need to think of those fees as a proportion of the returns. And it's not only that, it's actually higher. In this case, it's higher than a third of the returns, because you lose the ability to grow the investment that you would have had if you'd kept that 2% as well, which is why it's 40% and not just 33%. So after having a plan that you can stick to, minimizing fees is actually the single most effective tool that we have as investors to maximize our wealth over time. But don't just take my word for it. You might recognize this guy. This is Warren Buffett. And even Warren Buffett says this: if your wife is going to have a baby, you better call an obstetrician than do it yourself. If your pipes leak, you should call a plumber. Most professions add value beyond what the average person can do for themselves. But in aggregate, the investment profession does not do this, despite $140 billion in total annual compensation. So jump forward another year, and I was going to get married. And at that point in time, my wife and I realized how important it is to have full disclosure about financial issues when you plan on spending your life with somebody else. Because money is a huge risk to marriage. And of course, marriage breakdown is a huge risk to your money. Again, I've got some kind of scary statistics for you. 99% of engaged couples think it's important to talk about money together, but only about a third had that conversation. Money is the leading cause of relationship stress leading to divorce, according to several studies. 20% of people in long-term relationships hide large transactions from each other. over a third don't consult each other before they make large purchases. And of course, divorce is very expensive. So one of the smart things that my wife and I did right at the beginning of our marriage was we read this book together. And this book did a couple of things for us. But one thing that it pointed out is that in every relationship, there's always going to be somebody who's a little bit more of a spender, and there's always going to be somebody who's a little bit more of a saver. And this is not a value judgment, it's just a fact. We're all different. And so you need to organize your financial life in order to accommodate for that reality. The way we did it, and the way that several other people that we know did it, and this has worked well for us for the better part of 15 years, is that we set up separate spending accounts for ourselves. Because even though most of our expenses are shared, we all need some autonomy and independence to spend money just the way we want to without having to answer to anybody else. So every month we put away a couple $100 into our separate spending accounts, and we can either save that money or we can spend it however we want to. And that's really, really worked well for us over the years. But maybe the most important thing that this book did for us was it got us to think about and then discuss our personal values. Why do we believe that we're here on this planet? At the end of our lives, when we're looking back, what will have made our lives worth living for us? Those are our values, and no two persons' values are going to be exactly the same. But it was so important for us to think about what they were and discuss them out in the open, because that's really the only legitimate roadmap that we have to organize our finances. Because at the end of the day, if you're not using your money to support your values as a couple or as an individual, then you're not going to be successful with money. So I'd really encourage everybody, at no matter what stage of the relationship or life you're at, if you haven't done it, really reflect and figure out what your values are. Is it financial security, good relationships, procreation, helping those in need? For us, we shared the value of financial security and procreation, and we ended up having 4 kids. For me, one of my other values was adventure and new experiences and creativity, because I kind of have a little bit of an artsy side. But we needed to talk about these things together. At that point in time, we kind of set that up, and we thought we were doing pretty well. We thought we were being smart. But it didn't take long for me to realize that I wasn't quite as smart as I thought I was. Because as I said, I've always been a money geek. At that time, even, I was devouring as much information as I could. But I didn't quite know where to go to get good information. And so I was absorbing a lot of information from the financial media. And when you do that, you start getting all kinds of messages from so-called experts who are making predictions and sharing their analyses of what the next hot stock is going to be, or just basically making predictions about the future. And before long, with a little bit of information, you're stuck back on the Dunning-Kruger curve, but at the first section of it. With a little bit of information, you think that you can be the next Warren Buffett. These experts out there make it look easy, usually in hindsight, to maybe pick the next hot stock. We all know these stories about Apple or Google, and you start believing that you can do it yourself. And I did dabble in this a little bit, and it never really, none of them really worked out for me. But I stopped relatively quickly because I was lucky that I started reading this book, which is called A Random Walk Down Wall Street, which is now really a classic in the investment world. And what it does is it talks about something called the efficient market hypothesis. Without getting too technical, really what the efficient market hypothesis says is that it's pointless to try to pick the next hot stock or try to time the market, because the stock prices already take into account all of the available information out there. Now, most people don't believe the efficient market hypothesis is true 100% of the time, but it's true often enough that certainly the average investor is not really in a position to take care of any tiny little market inefficiencies that are out there. The real value of this book was that it systematically dismantled the arguments for what's called active management. And if you don't know already, active management is just really two things. First of all, it's this idea of timing the market based on what stock prices have been doing and kind of predicting what's going to happen next. And then the second aspect of it is picking hot stocks. So timing the market is something that people have been doing since the beginning of the stock market. And of course, there's good reason for that. As human beings, we are wired to find patterns in things, even when there are no patterns. This is why we can see pictures in clouds on a summer day. And similarly, if you look up at the stars at night, like this series of stars here, what does that look like to you? Well, we've been doing this for thousands of years, and our ancestors saw a crab there. Again, we're wired to superimpose things we know onto random patterns. And it's the same with the stock market. This is a stock chart, and what somebody who's trying to time the market would do is look at this pattern and try to superimpose patterns that they already have in their minds onto that randomness to give them a signal for what might happen next. And this is called technical analysis. Unfortunately, the evidence does not bear it out. It's essentially equivalent to reading tea leaves. But what about the second part of active management, which is picking hot stocks? Well, again, the evidence is quite clear about this, that really as human beings, we're no better than a blindfolded monkey throwing darts at a stock chart. Nobody can really pick hot stocks reliably. The best way that I can explain why this is true is because the stock market is essentially like a game of poker. If you've got 6 guys who come together for a night of poker, at the end of the night, their wealth will be redistributed. There will be winners and losers. Some people will leave with more money and some people will leave with less. But no wealth was created. And the stock market is exactly the same way, because for every buyer, there must be a seller. So the stock market is not so much a wealth building machine as a wealth redistribution machine. Even Warren Buffett, again, he commented that he's frequently asked by his friends how they should invest their money. And he tells them to invest in index funds, which is just a fund that tracks a specific index and doesn't try to pick individual stocks and doesn't try to time the market, just buy and hold. It's a very, very low fees and very, very effective over time. And he believes in this so much that he actually put out a wager, and he invited any hedge fund to bet him $1 million that a low-cost index fund would outperform any hedge fund over a 10-year period net of fees. And so this is the wager that he put out. It actually took over 2 years for a hedge fund to take him up on his bet, but eventually Protege Partners did back in 2008. And so for 10 years, a lot of people in the industry waited with bated breath because they had a lot riding on this wager. At the end of 10 years, though, the hedge fund returned 2.2% per year. The reason why there's 4 numbers there is just because the hedge fund was composed of 5 separate funds grouped together. So 2.2% versus 8.5% net of fees for the S&P index fund. So what that means in real terms is that a simple do-it-yourself approach that is available to all of us, and we could set this up in a few hours for almost no cost, beat the experts by almost 400%. So here in Canada, I think one of the best and easiest resources to just figure out the nuts and bolts of how to do this yourself is just go to the Canadian Couch Potato website. And they've got a couple of model portfolios there that you can choose from depending on what your risk tolerance and time horizons are. And again, nobody should be intimidated by this. This is incredibly easy. Okay, so jump forward a couple of years to 2008, and most of us will remember that this was the year when the shit started hitting the fan in the stock markets. This is what the stock market was doing, and you can see the big crash there highlighted in yellow. And I kind of had the presence of mind to know at the time that this was really history happening in front of me. So I was really observing as closely as I could what the so-called experts were saying. And it was really fascinating to see that these really well-known, well-educated, well-respected people were saying all kinds of contradictory things at the time. Some were saying that the real estate market in the States was going to have a soft landing. Of course, that didn't turn out to be true. When the crash happened, some people were saying that the worst was over. Others were saying that the worst was yet to come. In fact, this could be the next Great Depression or even worse. And then other people were saying, no, this time is different. And so what I learned in that year was that this quote by a famous Canadian named Lawrence Peter is really true. He said, "An economist is an expert who explains tomorrow why the things he predicted yesterday didn't come true today." I mean, the truth is, we look to experts to have a better handle on things than we do. We look to them for guidance, but the fact is that stock markets are way too complicated for really anybody to predict reliably. Now, the other interesting thing that came out of this was that the paradox is that even though market crashes feel pretty terrible for just about everybody involved, it's actually one of the best things that can happen, especially to a young investor, but really any investor who has money to invest and has a long time horizon, because everything goes on sale. As Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. So one of the things that we did right at the time was we really redoubled our efforts to invest as much as possible in the stock market when prices were cheap. And so that was something that we did right. But my intelligence as a do-it-yourself investor didn't last all that long, because a couple of years later, I learned firsthand about something called confirmation bias. I became really fascinated with market history, given that I knew that market history was happening at that time. And specifically, I became interested in previous market crashes. I was reading books like this, and I again fell into the trap of that a little knowledge can be dangerous. So most people think of the 1929 stock market crash as being a fairly sudden event. But the truth is that the stock markets at that point in time didn't hit their lows until 3 years later. And I was really fascinated by this fact. And I started reading more and more about it, and more about the similarities between the situation in 2010 and 1929 with levels of debt, etc., etc. And I became convinced that we hadn't actually hit the bottom yet, that we were going to have a double dip and that things were going to get even worse. So I got out of the stock market in 2010 for the most part. And of course, I missed out on a 15% gain for that year. What got me back into the market was really a realization that all I had to do to be a more effective do-it-yourself investor was to apply my knowledge and skills in evidence-based medicine to money. So what is evidence-based medicine? Evidence-based medicine is really just this confluence of clinical judgment, relevant scientific evidence, and then combining that with your patient's values and preferences in order to come up with a management plan. And this is the same when it comes to personal finance. We take our clinical judgment, which is things like our risk tolerance and our knowledge level, and coming up with a plan that we can stick to. Combine that with the relative scientific evidence, which is just simple things like asset allocation, which just means your proportion of stocks and bonds and cash, asset allocation, diversification, and low fees, and then combine that with your values. What are your values? Or is it financial security? Is it lifestyle? Maybe the legacy that you're going to leave behind. And what evidence-based money allows us to do is it really allows us to avoid cognitive errors to improve performance, because it's these cognitive errors that are dragging our performance down more than almost anything else. Things like confirmation bias, anchoring, sunk costs, and loss aversion. What this means in real terms is something called the behavior gap. Trying hard to eliminate the behavior gap. And this is a really important concept to understand. So when we're looking at past performance of investments, whether it's a mutual fund or an index fund, there's a number, which is the investment returns over time. So for the S&P 500 index, that might be 9.14% in this case over a certain time period. That is distinct from the investor's performance, which always lags behind the investment performance by at least 2 to 4%, depending on what study you look to. And that's all because of investor behaviors. We're human beings and we fall into these cognitive errors and we make bad decisions. So again, this goes back to having a plan that you can stick to. The good news is that it's totally reasonable to expect that we can be very effective do-it-yourself investors, even compared with the professionals. As boring as it looks, this is actually one of my favorite simple charts. This is just a chart that shows that on a daily basis, the stock market has about a 50-50 chance of going up or down. Over any 1 year interval, it has about a 3/4 chance of going up and a 1/4 chance of going down. But over 20 years, there's never been a 20-year period in either the American or the Canadian stock markets where the stock market has gone down. And the reason why this is relevant to us is because the professionals are trying to hack this system. They're trying to hack the quarterly system because that's how they get evaluated and compensated based on their quarterly results. But as a do-it-yourself investor, we have the luxury of having a much longer time horizon. We're hacking this system. So to put it another way, it's actually far easier to get rich slowly than it is to get rich quickly. We can adopt a much simpler, evidence-based approach in order to reap those higher long-term returns. And again, don't just take my word for it. Charlie Munger is Warren Buffett's right-hand man, and he said, "Simplicity has a way of improving performance by enabling us to better understand what we are doing." So in my case, I was able to get back in the saddle again after being out for 2010 with an evidence-based approach. And it's not the same for everybody. For me, it was a combination of the couch potato approach, which is simply buying and holding index ETFs, and another systematic approach called beating the TSX, which is a systematic approach to buying and holding blue chip dividend paying companies, which I may do another video about another time. So I pretty much figured out our investment strategy by that point, and it hasn't really changed much since then. But there were some really important aspects of personal finance that I still hadn't grasped. I was on track investment-wise to retire in my mid-50s, but I was becoming a little bit unhappy with my work at that point in time. So this is just a graphic to show the big circle was my life. Medicine, my job, was taking up a large proportion in my life. But I hadn't really asked myself a really important question, which is how much of that income that I made from my job did I need to spend to be happy? Was it 95% or maybe just 60%? Because I was starting to realize that what I was spending, the things that I was spending my money on, were not necessarily making me happier. They were just also taking up more of my life. Some of you may be familiar with the research that it shows that happiness does increase with income, but only up to a certain level. After about $70,000 per year, happiness actually doesn't increase at all anymore after that. And so I got reflecting on this on a personal level. If 99% of the world can maximize their happiness based on $70,000 a year, why is my happiness so fragile or precarious that I felt like I needed so much more? And what it boils down to is that, we need a certain level of spending for the basics like food and shelter. We need a little bit more to make those things comfortable, and a little bit more to also have opportunities for education and self-improvement and even entertainment. But the truth is that spending beyond a fairly low level of luxury is really just a reflection of our ego surpassing our income. And that has an effect of dragging our spending higher and higher and higher. Nigel Marsh is an author who did a great TED Talk a couple of years ago that's worth watching. And one of my favorite lines in it As he says, there are thousands and thousands of people out there living lives of quiet, screaming desperation, where they work long, hard hours at jobs they hate to enable them to buy things they don't need to impress people they don't like. And what he's referring to here is something called the hedonic treadmill. So if you've never heard of this before, the hedonic treadmill just is an illustration of the way that we're wired as human beings. We're not wired to be good with money. What we're wired to do is to compare ourselves to other people and to adapt to new situations. And this can really sabotage our happiness. I mean, picture yourself driving to the hospital or driving to your work for a shift, and you're driving your 4-year-old Honda, which is still a perfectly good car. But as you're walking through the parking lot, you see a shiny new BMW 3 Series. And it's beautiful. And you see it, and a part of you wants it because you think that it's going to make you happier. But if you take that next step and buy it, there will be a little bit of a thrill for a little while, but it won't last long because we adapt to that situation. And then maybe 6 months or a year later, when you're walking through the same parking lot, you don't even see those BMW 3 Series anymore. All you see is the shiny new 7 Series and maybe the brand new Teslas. And you can keep on going around in this circle. That's why it's called the hedonic treadmill. And really all that leads to is unhappiness and burnout. And so we'd figured out what doesn't work, but we hadn't really been able to put our finger yet on what we should do. Because it turns out that just like there's evidence-based medicine and evidence-based investment strategies, there's actually also evidence behind happiness. It turns out the things that make us happy are the things that have been making human beings happy for millennia. It's good relationships, our health, eating good food and making time to work out. Things like flow experiences. So if you're not familiar with that term, that just means activities that you can immerse yourself in that are intrinsically rewarding in themselves. You know, for me, it might be painting. For other people, it might be playing an instrument or a sport. And then lastly, philanthropy, which is just doing nice things for other people, even though you don't have to. This is what makes us happy. It's not big houses and luxury vehicles. To put it another way, as Gandhi said, happiness is when what you think and what you say and what you do are in harmony. You know, my observation is that so many of us say that what's most important to us are things like our health and our relationship and following our passions. But so many of us are killing ourselves at work to support a lifestyle that works against all of those values. So what's the solution? The solution is savings. Now, savings gets a bad rap, especially in our culture. You know, when you mention the word savings, it feels bad because it feels like you're forcing yourself to do without. But I think somehow we need to change our attitude toward savings. And for me, savings are important because every single dollar that you don't save now is a piece of your future that you're handing control over to somebody else. So in a couple of years, when something happens in your life, you want to have the option to go hiking in Peru with your friends rather than grinding it out during another shift long past the time that it stopped being fun for you. But how much should you save? Let's just go into that for a second. You know, there's this 10% rule made popular by the wealthy barber. So if you save 10% per year, how long do you think it'll take you to be financially independent? 10 years, 20 years, 30 years, 40 years? It'll actually take you 40 years. Now, there's nothing wrong with that as long as that's in line with your values and what you want out of life. It's just really important that we understand the relationship between spending and saving and how long that might take us to achieve financial independence. So this is a great website that you can go to called networthify.com, and it'll do all the math for you. So this is just a graph showing that with a savings rate of 10%, it'll take you about 40 years to become financially independent. Now, contrast this to a savings rate of 40%, and it'll take you about 20 years to become financially independent. But why should we focus on saving rather than investment returns? Back at the beginning, I told you guys that the conventional advice is that most people focus on what their potential investment returns are rather than their savings rate. Mathematically speaking, we should all be focusing more on our savings rate than our investment returns. First of all, because mathematically they're far more important, as I'll show you in a second. And secondly, because we can control our savings rate, but we can't control our investment returns. But again, the math is pretty simple. It'll take over 10 years for your investment returns to even equal the wealth accumulation that's due to your savings rate. So this graph shows that if you're saving about $50,000 a year and you're earning about 7% on those investments, it'll take over 10 years for your investment returns to equal your savings rates. But why are savings so important anyway? For the longest time, I thought that savings were really just for retirement. But it's not just about retirement. I think the most important reason to save is because even though we hope our life is going to look like the top line there, relatively straight and smooth, life is going to throw us curveballs. Whether it's a relationship breakdown, or whether it's a health problem, or whether it's professional burnout, when those things happen, you want to be in a position of financial security and flexibility so that you can explore options at that time. So for me, as I mentioned before, I started to reach a point a couple of years ago where I just wasn't sure if I wanted to do it full time anymore. So I gradually decreased my shifts over the last couple of years, and I'm now approaching a stage where I'm actually going to take a break completely. And that's not a negative thing for me. Because even though my wife has never worked outside the home, we've accumulated a bit of a nest egg now, and that can now serve as a second income for our family. Because investments generate income in the form of capital gains, dividends, and interest. And it's fairly well established that you can take out 4% of your nest egg every year sustainably. And that, again, can serve as a second income for your family. So in our case, I'm going to use this time when our kids are young and our financial independence, and we're going to take a trip around the world, backpacking around the world with our family for at least a year. I actually wrote a little article about this for a magazine called The Canadian Money Saver, which is a great resource for unbiased advice for people who are interested in personal finance. So in conclusion, we've got some problems with money in our culture that I hope that we can start addressing. Even though we've had more money and we have more money and resources than we've ever had before, so many people are caught on that hedonic treadmill of just kind of doing what everybody else is doing rather than making their money work for them to create the life that they want. Unfortunately, the solution, at least in my eyes, is relatively simple, if not easy for everybody. But the solution is really to have a simple, low-cost, evidence-based plan. Spend our money on relationship and shared experiences and not just stuff. And lastly, we should all be probably saving more than we think so that we can be financially independent in a reasonable time frame so that we have the ability to roll with the punches when life throws us those curveballs and we have options rather than feeling trapped. So whether you're a DIY investor or not, I hope that my little presentation here has given you some food for thought and that it gets you thinking about how you can make your money support your own values and help you to live a life that is meaningful and more fun for you. So thanks for watching and listening, and feel free to leave a comment below or subscribe to this channel. And I'm interested to hear your thoughts. Thanks.